Alright guys, something is about to happen to your 401k and your retirement account that most people have no idea is coming. And it's happening whether you want it or not. Two of the most valuable companies in history are about to go public, and because of their sheer size, they may fundamentally alter what sits inside of millions of Americans' retirement accounts. The company SpaceX is going public on June 12th, and that is just 3 days from today. And it's opening at a valuation of $1.77 trillion, making it the biggest IPO in human history. And right behind it in line are OpenAI and Anthropic, also preparing their own public listings. These three companies, with a combined valuation of roughly $4 trillion, are all going public within months of each other. And the rules of the financial system were quietly rewritten just weeks before all of this to make sure that your retirement money automatically buys them. So guys, I ask that you stick with me all the way to the end of this video because I'm going to give you the full picture of what's happening here right now, why the timing matters so much, and most importantly, what, if anything, you can do about it. Okay, so let's start with the mechanics of how your 401k is going to end up owning SpaceX, because this is the part that nobody tends to be explaining very clearly. So in case you don't know, there's something called the NASDAQ 100. It's the gold standard index for the biggest tech companies, and there are hundreds of billions of dollars worth of investment products that automatically track it. When a company gets added to the NASDAQ 100, every single fund that tracks that index is forced to buy that stock automatically. There's no vote, there's no choice, just automatic buying worth billions of dollars. And getting into that index is essentially a money printer for any company that qualifies. Now, here's where things get a little interesting. The rules around getting into the index just changed. On May 1st, the NASDAQ introduced what they're ruling the fast entry rule, which does three things. First, it cuts the waiting period for a new company to be added from what used to be a year down to just 15 trading days. Second, it eliminates the float requirement that would have disqualified SpaceX outright, because SpaceX is only listing about 4 to 5% of its shares publicly, and the old rule required a minimum of 10%. And thirdly, and this is the hidden part, for any company with a float below 20%, the index now artificially inflates how the stock is weighted, meaning index funds are required to buy more of it than the actual available supply would normally justify. And analysts estimate conservative forced buying of $15 billion to $30 billion across S&P 500, NASDAQ 100, and Russell 1000 trackers in the months after inclusion, with more aggressive float-weighted scenarios running far higher. FTSE Russell followed suit with its own fast entry mechanism, allowing inclusion just 5 days after listing. Each of the requirements now on the chopping block was built for investor protection, the profitability test was a quality screen, and the season period existed so a newly public stock's price had time to settle before trillions of dollars of regular people's monies were pegged into it. And now, unfortunately, with that being said, both of those protections are now gone. So now, let's talk about what SpaceX actually is as a business, because the dream and the reality are two very different things, and you deserve to see both. So to start, SpaceX is really three separate companies all bundled together under one name. First is their rocket business. Things like government contracts, NASA missions, reusable rockets, etc. That did about $4 billion in revenue last year. Next is Starlink, the satellite internet service that has 10 million subscribers already across 150 countries, and that generated over $11 billion in revenue with genuinely impressive profit margins. Starlink is a real profitable, growing business. But last but not least, there's a third piece, and that is xAI, which is Elon Musk's artificial intelligence company that is burning over $1 billion a month. And guys, when you bundle all of that up, SpaceX as a whole lost $4.9 billion last year. And just in the first quarter of 2026, even as revenue grew 15%, losses were up 700% year over year. And I just want to repeat that one more time. Revenue went up 15% and losses went up 700% in the same quarter. And why do I tell you this? Because you're being asked to buy into all of that at a valuation of $1.77 trillion, which works out to roughly 107 times the sales value. So guys, just to put that into perspective, when Meta went public, it was trading at 28 times sales value. And with that being said, Meta had 88% revenue growth at the same time. But SpaceX, on the other hand, it has 15% revenue growth and exploding losses. That comparison alone should stop you cold in your tracks. For further context, just look at what happened to companies that came to market at a fraction of that multiple during the dot-com era. Cisco, one of the most respected tech companies in the world, traded at 25 times sales at its peak and then declined to 90%. And then taking until December of 2025, 25 years later, to finally break its year of 2000 high. Amazon, on the other hand, declined 97% from its dot-com peak before eventually recovering. Microsoft declined 65% and took nearly 17 years to make a new high. These were genuinely great companies with real businesses. The valuation is what destroyed early investors, not the technology itself. And SpaceX is coming to market at a multiple that makes all of those companies look conservative by comparison. Now, real quick, guys, if this video is giving you any value at all, please show some love by smashing that like button, leaving a comment down below, and subscribing. Your support genuinely helps this channel grow, so please show some love by smashing that like button, commenting down below, and subscribing. Alright guys, now let's move on to the next segment. Okay, so here's the layer of this story that goes way beyond just SpaceX, and it continues directly to why these three companies are all rushing to go public at exactly the same time. The entire AI boom that has been propping up the stock market and justifying trillion-dollar valuations is built on what some analysts are now calling an earnings bubble, and it works like this. The biggest tech companies, Microsoft, Google, Amazon, Meta, they've all been investing hundreds of billions of dollars into AI startups like OpenAI and Anthropic. Those AI startups then use that money to rent computing power and infrastructure back from the very same big tech companies that invested into them. The big tech companies then book those payments as revenue, which inflates their earnings, which keeps their stock prices high, which justifies spending even more. The money is essentially just going in a circle. And analysts at the Financial Times looked at how much Microsoft, Google, Amazon, Meta, and Oracle are planning to spend on AI infrastructure between now and 2030 versus how much they are actually expected to make back from those investments. And unfortunately, but not surprisingly, the results were alarming. Even under the most generous possible assumptions, with zero costs and no overhead, Google's implied return was negative 15%, Meta's was negative 28%, and Oracle's was negative 35%. The only company that cleared into positive territory was Amazon, just at 7%. JP Morgan analysts are now projecting that by 2027, several of these companies will have negative free cash flow, meaning that they'll be spending more than what they bring in. And this circular system only holds together as long as everyone agrees on the valuations. The moment SpaceX, OpenAI, and Anthropic go public, their valuations stop being whatever a private funding round decided, they become whatever the open market decides. And if those numbers come in lower, the paper profits that have been holding up the entire AI earnings story gets revised downward very fast. So now, here's the most important question. Why are all three of these companies going public right now, at the same time, at the biggest valuations in history? And the honest answer is that the window is closing and the people on the inside know it. Every single major index provider, NASDAQ, FTSE Russell, and potentially the S&P 500, changed their rules within weeks of each other, all timed to land right before the biggest IPO wave in history. The NASDAQ's rule changes were announced with comments closing May 28th, taking effect June 8th, and SpaceX beginning trading on June 12th. And guys, let's be real, that is not a coincidence. That is coordination. And the macro environment is adding urgency to all of it. Index providers waived the profitability requirement and cut the seasoning window from 90 days just down to 5, forcing over $30 trillion in passive 401k and retirement money to buy SpaceX at IPO valuations. And as you know from my recent videos, oil inventories are approaching critically low levels. The Strait of Hormuz remains disrupted, treasury yields are rising, and Kevin Warsh's first Fed meeting is on June 17th, with markets pricing in a greater than 50% chance that rates go higher by year end. And all of those pressures together create a shrinking window for these IPOs to hit at maximum valuation. And guys, let me tell you right here, history has a very clear pattern on this. The most hyped, the most culturally significant IPOs in American history almost always land at the exact moment when public excitement is at its absolute peak. Companies like Xerox, Ford, McDonald's, Apple, Goldman Sachs, in almost every case, the market peaked right after the IPO because the IPO is rarely about the companies needing money. It's about the sellers needing buyers. And the best time to find buyers is when everyone wants what you're selling. Alright, so as I wrap up this video for you, this is the section where I'm going to explain what you actually do with all of this information. Because I don't want you just walking away thinking that investing is broken or that you should panic sell everything. That is not the message in this video. The message is this: know what you own and why. Starting as soon as this week, your total market index fund, you know, the plain, boring ones sitting inside millions of 401ks right now, is likely going to be one of the first funds that owns SpaceX. And according to investment advisors, the first fund to own SpaceX won't be the famous NASDAQ tech fund. It'll be the plain total market fund, sitting in millions of 401ks. So unfortunately, you don't get a vote on that. But the first thing to do is simply be aware of it and understand that your passive investment exposure just shifted in a way that you didn't choose. The second thing on my list, and this is the one that I really want you to sit with, SpaceX has reserved 30% of its shares specifically for retail investors. That is 3 times what normal IPO typically sets aside for everyday people. And I want you to think carefully about why that is. Private investors got in years ago at a fraction of today's valuation. They've been sitting on this equity for over a decade, and now they want to cash out. And of course, to do that, they need buyers. A lot of buyers. Buyers willing to absorb billions of dollars worth of stock at peak valuations so that the early insiders can walk away with their gains. And retail investors aren't being given special access out of generosity. Retail investors are the exit strategy. If you're thinking about actively buying SpaceX shares on the open market when it starts trading on June 12th, understand that you are almost certainly not getting IPO shares at $135. You're buying on the open market after it's already gapped up or down, which means that you're volunteering to be what Wall Street calls exit liquidity. The better move, in my opinion, if you believe in the long-term story, then just wait. Let the lockup periods expire, let the first earnings reports land, and let the frenzy sort of burn off. And then evaluate at whatever price the market actually settles on. Technology winning and investors winning are two completely different things, guys. And that pattern has repeated itself throughout every major boom in market history. If the AI and space economy story is real, and there's a real case that it will still be real even at a lower price at a later time. And if the valuation story stumbles, you'll be glad that you let someone else find out first. So guys, I want to thank you for watching this video all the way through. I come out with content every other day, so please smash that like button, leave a comment down below, and subscribe so you don't miss any of the upcoming videos that I put out that speak on this matter, speak on oil, speak on politics and finances in general, because I'm here to make sure that you're not destroying your financial future, only building it, preferably. And please, if you do comment down below, let me know. Are you planning on buying SpaceX on the day of the open, or are you going to wait it out? I genuinely want to hear from each and every one of you, and I'll probably have a better idea of what it looks like even from the people on this channel. Guys, I want to thank you again for watching this all the way through. I'll see you guys in the next video.